Gold is actually something you should have, or a little bit of silver if you want to speculate on EV and all this sort of stuff. So it's only just starting. To summarize, the fact that the retail market has been sellers this year, while the professionals have been buying, is actually the clearest indication that you've got that this is in the very, very early stages of a big bull move. So the point about this is that in 2025, as bond yields rise, and particularly the 10-year, we'll see that go through 5%, I think probably in the first quarter of this coming year. If that happens, and I think it will, then you'll find that banks and businesses will be getting into trouble. So what does the Fed do? It will move heaven and earth, Fed and Treasury, to ensure that no bank defaults on its obligations to its depositors. So what we're looking at, I think, is a bailout of the entire system.
In today's news recap, silver price surge expected in 2025 as UBS predicts $38 target amid industrial strength. UBS anticipates silver prices climbing to $36 to $38 per ounce by 2025, driven by falling U.S. yields, robust industrial recovery, and stronger demand. Despite recent headwinds, the metal's dual role as precious and industrial could fuel its growth. According to investing.com, silver prices are expected to increase in 2025, according to UBS, which is boosted by lower real rates in the United States and higher global industrial production. This is despite the fact that the metal is struggling to match the increases spurred by the central bank in gold. Silver prices increased by more than 20% in 2024, but they have recently lost impetus as a result of increasing yields in the United States, a strong dollar, and growth concerns in global markets. With speculative short positions expanding and ETF holdings stabilizing following major outflows earlier this year, the metal is trading near its 200-day moving average. This represents a positive development for the market. In spite of these difficulties, UBS continues to retain its positive stance with a target price range of $36 to $38 per ounce for the year 2025. Although rising yields have been a disadvantage, a decrease in yields might potentially improve the desirability of silver. There is a need for a shift towards cyclical commodities, which UBS anticipates will become more prevalent as the year 2025 progresses. Dual roles of silver highlight its market potential. Despite the fact that silver's association with gold continues to be high, the fact that it also moves in tandem with industrial metals highlights the fact that it serves a dual purpose as both a precious metal and an industrial metal. Now we'll show you the best clips of the latest interview where Holter talks about his price predictions, but first, smash that subscribe button and check our pinned comment for some massive offers on NordVPN. If you're a serious stacker, this is a perfect fit for you. For less than the cost of a Financial Times paper, you can protect your online activity from prying eyes with the most reliable VPN on the market. Trust me, the only thing you'll regret is not getting it 6 months ago. Enjoy the episode.
The only people who participate early in the next bull market are basically the people who really know what they're doing. You know, the real pros. The guys, for example, sort of in, let's say the mining industry, something like that, who understand mines. They're in there buying stuff and it's sort of accumulating in their hands. You get M&A activity. This sort of thing begins to build. And as the M&A activity begins to build, then you find that there's a wider investment community. But again, very much investment managers, experienced guys who will go in and drive the second wave. And towards the end of the second wave, some of the public begin to sort of think, markets are going up. Perhaps we ought to buy some. You then get another correction. I mean, Elliott Wave fans will know, will feel the description. But then the last bit is the last bit of the bull market is where all the idiots, who've missed it, pile in because they know they're missing something and it's going up, and they buy it just because it's going up. Now, we are, if you like, in those terms, in phase one. And so to see the public selling while the professionals are buying, which is what Andy was saying, is exactly what's been going on. It's that very, very early stage. You can take these comparisons a bit too far because obviously we're not talking about investment, we're talking about protection. And we're talking about getting out of credit and getting into money. But the psychology basically is the same. I mean, even Germany, who's had two wipeouts, currency wipeouts, since the 1920s, 1923 and also following the Second World War. I mean, they're not buying gold. People are not buying gold. They're not sort of putting some aside. They've been selling. And if you look at, ETFs, the dreaded ETFs, which are not a substitute for gold or silver, it's only recently that there has been a little bit of buying, if you like, in Western capital markets. But that buying hasn't been really individuals. It's been some of the funds, run by guys who maybe listen to us a little bit and have got this sort of idea that gold is actually something you should have, or a little bit of silver if you want to speculate on EV and all this sort of stuff. So it's only just starting. And so really to summarize, the fact that the retail market has been sellers this year while the professionals have been buying is actually the clearest indication that you've got that this is in the very, very early stages of a big, big bull move. Well, I think what the banks are doing is what they've also been doing in 24. That is, they're trying to de-risk their balance sheets. Now, an individual bank can reduce its balance sheet. Point being that the leverage within the banking sector is uncomfortably high, and it became uncomfortably high because margins were suppressed at the time when we had zero interest rates. And if you look at the banking systems in Japan and also in the Eurozone, where they went, where the central banks drove interest rates into negative territory, I mean, the leverage there is far greater. So, leverage is a function, if you like, of how the banks responded to the suppression of interest rates. So they're now left with higher interest rates and too much leverage on their balance sheets. They're trying to reduce that. The system as a whole cannot reduce its balance sheet for the very simple reason that once credit is created, it doesn't disappear. I mean, people make the mistake of thinking that, we get into a deal, we do the deal, I pay you, you deliver to me, end of credit. No. What happens is the credit gets passed on to other parties. If I pay you, it goes into your bank account. And if you pay someone else, it goes into someone else's bank account. All that's credit. And even cash is credit. It's not proper money.
In today's episode news recap, silver almost keeps pace with gold in 2024. Silver surged 24.4% in 2024, driven by industrial demand, supply deficits, and investment potential via ETFs like ISLN. So congrats to the savvy stackers on their silver holdings. As 2024 draws to a close, silver has emerged as a standout performer in the precious metals market. Although gold has performed slightly better so far, plus 27.8% year to date. Silver benefits from its dual role as both an industrial and investment asset. On the other side, silver has jumped 24.4% so far in 2024, nearly matching gold's performance as of December 27th, after rebounding from a 3-month low of $29 per ounce on December 19th. Silver ended the week at $29.61. This rebound was driven by macroeconomic factors, rising industrial demand, and indirect support from aggressive central bank gold purchases. These drivers could support silver's continued upward momentum in 2025. Unlike gold, approximately 55% of silver's demand comes from industrial applications. In 2024, this demand surged, fueled by the growth in the electronics and renewable energy sectors, particularly photovoltaic, solar technologies. Solar energy alone now accounts for nearly 20% of industrial silver consumption, highlighting the global shift towards sustainable infrastructure. This heightened demand has led to physical tightness in the silver market, resulting in a supply deficit for the fourth consecutive year, according to the Silver Institute. Miners continue to face significant challenges in discovering new silver deposits, further exacerbating the structural supply deficit. This combination of robust industrial demand and constrained supply positions silver as a compelling candidate to outperform gold in the years ahead, especially as global interest in renewable energy continues to grow. Before we dive into more clips, make sure to smash that subscribe button and check our pinned comment for exclusive VPN offers. Protect your online privacy with NordVPN, the fastest and most reliable service out there. Just a few clicks secures your data and keeps unwanted eyes at bay. Plus, if you're a stacker seeking truly independent market insights, visit goldsilverstacks.com for our Stacker's Handbook, loaded with strategies to safeguard your financial future so you don't rely on commentators for market insights. Enjoy the episode.
The point is that you have the entire system trying to de-risk itself, not by, in aggregate, reducing its overall level of credit, but by, if you like, taking funds away from the private sector and applying them to government, and specifically applying them to government through the T-bill market rather than longer-term maturities. That's the way in which the banking system de-risks itself. The problem with that, obviously, is that it kills the private sector. And, Bill made the point earlier about, the falsity of the GDP numbers, because so much of it is actually the expansion of government credit, which is it's inflationary. It's not it's not credit aimed at production in any sense. Production in the sense that the private sector is producing something that people actually want, that they will actually demand. No, this is credit which is produced by a government which says, you will have this, you will have that. Now, this is inflationary. So this is the background against which the banking system operates. Now, there are ways in which the level of outstanding bank credit can be reduced. The first is businesses go bust. And I think we're going to see quite a lot of that in 2025. And the second is that banks go bust. If you look at what happened in the 1930s, when money supply contracted by something like 40%, it weren't because the credit was sort of, if you like, being, contracted by the banks. No, it was because banks were going bust and businesses were going bust. When an obligation is no longer available, the credit on the other side disappears. It's completely worthless. So the point about this is that in 2025, as bond yields rise, and particularly the 10-year, we'll see that go through 5%, I think probably in the first quarter of this coming year. If that happens, and I think it will, then you'll find that banks and businesses will be getting into trouble. So what does the Fed do? It will move heaven and earth, Fed and Treasury, move heaven and earth to ensure that no bank defaults on its obligations to its depositors. So what we're looking at, I think, is a bailout of the entire system. But we have an interesting point about the central bank's involvement in this, because the Fed is deeply underwater in negative equity because of all the losses that it has had from the past from QE. You think the Fed's got problems, just look at the back of Japan. I mean, that's just crazy. Any rise in interest rates there, I mean, the whole system sort of threatens to fall over. The ECB is also in the same sort of position, but not quite as bad as the Bank of Japan. Now, you can recapitalize a central bank quite easily. I won't go into how to do it. But the one thing that actually is going to be very, very difficult is to recapitalize the ECB. because the shareholders, or key holders as they call them, are the national central banks. The national central banks, in most cases, will have to go to the political class to get permission to recapitalize themselves and to, if you like, recapitalize their share of the ECB. That's not going to happen. So I can see that the euro actually could be beginning to just completely disappear under these circumstances in, if you like, a global crash. Now, there is going to be a huge, great panic as people realizing the dangers to credit actually start getting out of credit. What the hell do they get into? But if they try and get into, equities, forget equities, because when you see bond yields, particularly US 10-year Treasury bond yields go through 5%, I reckon that US equity markets will crash. It's quite simple, because the relationship between bonds and equities is already very, very stretched. And, going back to my experience as a stockbroker, noticing how markets top out, what tends to happen is that when bond yields start rising, equities go with it. They go into new high ground. But there comes a point, perhaps after a bit of a pause, where there's another wave of rising bond yields, and it's that kills the equity bull. We're going to see that, I think, in 2025, which is going to compound the problems for the banking system, because an awful lot of it is the collateral for loans, just in the same way as commercial real estate is the collateral for loans. And then what's going to happen to residential property, where you've got mortgages, where mortgage costs become unaffordable for increasing quantities of homeowners. As collateral, that's going to be perhaps the last to be undermined, but it'll be undermined. So this is, I think the Fed's attempts to keep the show on the road, kick the can down the road one more time, is going to fail. They must try it. And that, of course, will kill the dollar, because the foreigners aren't prepared even to help fund the US deficit at 5%, 6%, 10%, 15%. And the Fed is trying to push rates down at the front end of the yield curve. That's just going to kill the dollar. And that, I think, is basically what we're going to see. So coming back to what you were saying, asking about banks, I think banks will be the last to fail in the sense that they will be supported. But it's the whole system which is going to fail. And that's what we face.
And that's Alasdair Macleod's take on the evolving role of gold and the BRICS nations' ambitious plans to challenge the global financial order. What do you think? Do the BRICS nations' master plan for a gold-linked system hold the potential to reshape the global economy, or are the obstacles too great? Let us know your thoughts in the comments below, and don't forget to like and subscribe for more daily recaps. Now watch this video right here because it's a perfect fit for you. I'll see you on the other side.